The Federal Reserve just raised interest rates. What does this mean? How does this affect you? And what should we be looking at as investors during these uncertain times to make the most amount of money possible? So the first thing that we need to understand is why the Fed just raised interest rates. Well, as some of you may already very well know, inflation in the US is pretty much out of control. The CPI numbers for February, which is the Consumer Price Index, rose to 7.9%, propelled by surging costs for gas, food, and housing. Rising inflation makes you poorer, basically because the money that you have and earn becomes less and less valuable. To combat this, we need to figure out ways to reduce spending, because the less we spend, the less demand for goods and services there is. The less demand for goods and services, the more prices will come down. One of the ways that we can do this is by effectively decreasing the amount of cheap money there is in the economy. So how do we do that? Well, we need to start by making access to money more expensive. When borrowing money becomes more expensive, then less people will borrow money, right? And with less money out there, that will be better for inflation. So how do we jumpstart this process? Well, funny enough, the ones who caused the problem to begin with are now going to be the ones to try to fix it, ironically. 40% of the US dollars in existence were printed in the last 12 months by the Federal Reserve. And nobody thought that that would be a problem at all. No, everything's fine here. Now the Federal Reserve has stepped in and decided it's going to raise interest rates by 0.25% and will continue to do so over the next few years. Remember, higher interest rates means it's more expensive to borrow money, and this in turn will help level out inflation. But the real question is, how do higher interest rates affect you? The first thing to look at is credit cards, the backbone of America. Because interest rates will affect the interest paid for debt, then you can see how this will affect the debt that we all use every day with credit cards. Interest on your credit cards are variable, which means that they can change, and they increase and decrease based off of the overall interest rate environment. More specifically, credit cards use a benchmark interest rate known as the prime rate. The prime rate is effectively the rate at which commercial banks charge their prime creditworthy customers and then add their own percentage on top of that. The prime rate the banks use are largely determined by the interest rates set by the Fed. So when interest rates go up, prime rates will increase, and all of a sudden you're paying more to pay off your credit cards. This is why the first thing that you should do in this type of environment is pay off your credit card debt as soon as possible. And do not fall behind on payments, because this interest will only pile up. The second thing interest rate hikes will affect is your personal savings. See, when interest rates are low, you have no incentive to keep money in your savings account or fixed income like bonds. When interest rates go up, it'll have the opposite effect, leading you to save more, spend less, and this is another component in helping the overall inflation situation. This idea can trickle into investments as well. When we have low interest rates, money moves out of fixed income and moves into other riskier investments for potentially higher gains. So money piles into the stock market and the asset class rises. This is the reason that we've seen a crazy bull run for the past year in the markets. But when the lever is pulled and interest rates go up, that can have a negative effect on the stock market and the profits that you'll be able to generate from it. Now, during this time, there is going to be a lot of volatility in the market, mainly due to so many investors moving their money around between bonds and stocks, entering the market, exiting the market, and this is the cause of a lot of the volatility that we've been seeing recently. Growth stocks tend to fall off because of the effects of a slowing down economy. When you spend less on goods and services, this affects the profits of companies. So when growth companies that trade at a high multiple or high PE ratio stop posting higher earnings, investors take a step back and say, I don't know if this company at such a high multiple is worth it. It might be overvalued. And then boom, there is a sell-off. During times like this, I am of the opinion that the best place to invest would be companies that historically have done well during high interest rate environments. My first pick would be the banks, the financial sector. As rates increase, the bank's margins and profit increase along with it. Companies like Bank of America, JP Morgan Chase, and Citigroup would be amongst my top 3 picks if I were to invest in the sector. Insurance companies also tend to do well during high interest rate periods. Allstate, in my opinion, is a good company and a good pick for an insurance company. Lastly, the energy sector, in my opinion, is a winner due to high inflation and increased demand. The US decision to stop fracking led them from an energy independent country to a country that is dependent on foreign energy imports. This, coupled with inflation, is the reason that gas prices have skyrocketed. And although the war doesn't help the situation, you need to understand the reason that it's actually happening. If you were to invest in oil companies, for example, at the start of 2021, when demand increased and the money printing went through the roof, then you would have seen a very nice return. So here is the important question. Will rising interest rates lead us into a recession? Many fear that it will, because if interest rates rise too high or too fast, that will actually cause the economy, instead of slowing down, to come to a halt and even potentially reverse. If they are not raised enough, then inflation will spiral continuously out of control. So there is a delicate balance that needs to happen to ride this out smoothly. A recession is a period of declining economic growth, typically recognized as 2 consecutive quarters of decreasing GDP. Now, GDP stands for gross domestic product and is defined as the overall market value of all the goods and services that a country produces. It basically measures the size of the economy. This is important to determine if a country's economy is growing and expanding or shrinking. High GDP leads to high standard of living because the people that live within that economy benefit from creating and providing prosperous goods and services. If the GDP goes down, then the economy doesn't prosper as much. If GDP goes down 2 quarters in a row, as in 6 months consecutively, then we have hit recession territory, and well, that's not good. So what are the factors that we should be looking for to try to predict if we are heading towards a recession? Well, declining GDP, this is an obvious one, right? Another factor is real income, which is the money you earn adjusted for inflation and whether or not that drops. Manufacturing, net imports and exports, wholesale and retail sales, and overall employment. Now, here's the problem. These tend to be lagging indicators, meaning that to call a recession, we need to observe these numbers. So a lot of the times it's hard to actually predict until we are in a recession. Now, another very important indicator that can tell us whether we're going towards a recession or not is the inverted yield curve. The term yield curve refers to the relationship between short and long-term interest rates of fixed income securities. In this case, we are looking at the 10-year treasury yield, which is the long-term rate, and the 2-year treasury yield, which is the short-term interest rate. Typically, long-term bonds have higher yields than short-term bonds. And this makes sense, right? Hey, I'd like to borrow some money for a few years. Okay, but I'm gonna need a little bit of interest rate on that, you know? Actually, I meant I'd like to borrow some money for 10 years. Whoa, okay, then the interest payment has to be higher for me to lend you that money. This happens in normal environments, but what happens when investors lose confidence in the economy and expect economic growth to slow? Well, this would lead investors to pile into high interest rate bonds, causing the yield of those bonds to go down. This means that the spread between the short-term and long-term yields will get closer and closer together. Now, as you can see here, we are very close to that spread being 0. And if it goes negative, then it can mean real trouble. An inverted yield curve has accurately predicted every recession in the United States going back many years. And in recent times, it has predicted the dot-com crash, the 2008 Great Recession, and is perhaps now giving us a sign that a recession may be around the corner. So, are we heading for a recession? The honest answer is, I don't know, and neither does anybody else. But we'll know when we are actually in it, and then we can look back and in hindsight point out all those indicators and say, look, I told you so. So what should we be investing in? Well, it is my feeling that investors should perhaps focus this year on high-paying dividend stocks, coupled with companies that we mentioned that have historically done well during these types of environments. The financial sector, like I mentioned, can be a very great addition to your portfolio, and they also pay great dividends. The energy stocks as well, ExxonMobil, Shell, Phillips 66, all have dividend yields between 3 to 5%, and the idea is to substitute gains in typical growth stocks with income-generating companies. Look for companies with low debt and good cash flows in this environment. You need a company with with a good balance sheet to be able to ride out the wave of slowing economic growth. If you think inflation won't subside anytime soon, which I don't see this happening at least for this coming year, you can look at things like commodity, like gold and silver, or even better yet, cryptocurrencies. It is my personal belief that crypto will take off this year, with more and more investors piling into these alternative assets to try to substitute their returns. Now, if you want to see what I'm investing in, make sure that you check out my Patreon, link down below. Now, my goal with that is to take the money raised there and invest it back into making this channel and this community bigger and better. If you learned something in this video, go ahead, give it a like, subscribe for more, and thanks for watching. We will see you in the next video.